How much mortgage payment can you afford? I'm going to tell you exactly how to do the math so you can figure out affordability and what mortgage payment you would be approved for. My name is Ryan Skaggs, and this is the Mortgage Minute. This channel is dedicated to everything mortgage, real estate, and interest rates. Putting out weekly videos on the channel. I'd be forever grateful for that subscribe. Let's dive into our topic today, and we're going to start with an example. All right, let's jump into our example. I'm going to take you onto the whiteboard here. I've got it right here. We're going to start getting into an actual example. We've got $6,000 in this example, and that is our gross income. I'm going to come back to making sure we understand gross, but we can use roughly 50% of that income for underwriting purposes. This would be for all debts. And again, gross income, that's the amount before taxes are taken out, before 401k, before all of those items. If someone says net, that is after all those things. So gross income. So in this case, if $6,000 at 50%, $3,000 of total debt per month. And again, all debts. So that would be student loans. That would be if you're co-signed on something. That would be installment loans, car loans, credit cards, all of that. What also has to fall into that $3,000 is principal, interest, taxes, and insurance. And then that last A is any assessments. So if you're in a housing community or a condo or something like that. So again, everything needs to be in that $3,000. And this is showing you right here saying, okay, hey, installment loans. If you've got a car loan and that's $300, we got to take that into consideration. If you've got credit cards, we need to be able to do that as well, right? So all of those need to fall into that $3,000 total monthly debt. And again, this is if you are absolutely positively maxing out, right? So something to consider here in this scenario, and we're going to basically take you on the screen here next, and I'm going to show you an example of what it would be when we have a very specific kind of few credit cards and how to basically calculate that monthly payment. So let's jump into that. Okay, so now we've basically got an example that I'm going to start with you here together on the whiteboard again. So as you're looking at it, we're going to draw a line right down the middle here. So now we can give a specific example. But I'm going to start with what we already have. And that's the monthly debts before we get to what mortgage you should be doing or what monthly mortgage amount. Let's imagine we've got an installment loan of $300. Cars cost way more, but let's hope you've had it for a little bit. But let's assume a $300 installment loan of some kind. Let's assume you've got 3 credit cards. You put maybe $500 a piece on them or a couple $100, and you've got minimum payments of $30, and $40. So that would be now a total of $400 of debt. Now, quick tip here. If you use one credit card and you pay it off in full, you still have that monthly payment, so something to consider. But in this case, we've got $400. If you see me circling it here, $400 of monthly debt minus that $3,000 of maximum debt that we talked about in the previous conversation here. So as you see here, $3,000 minus the $400, you're going to have $2,600 of principal, interest, taxes, insurance. That includes mortgage insurance as well if you're putting less than 20% down. And then, of course, any assessments. So what I'm going to use for this example, and what I would suggest using if you're trying to do your own budget or calculate how much monthly mortgage payment you can take on, is let's say the assessments are zero. Let's say you're trying to buy a single family home. I like to use the example or the default of 0.25% for insurance. Okay? So if you're thinking about what that might be, 0.25% on a monthly basis, right? So, and we'll do some math here and I'll bring you onto the calculator. Got the trusty loan calculator right here. So we're going to talk more about that here in a moment, but 0.25 for your monthly insurance. Taxes. Here in the greater Chicagoland area, I use 2% for taxes just as a default. And then we use mortgage insurance of 0.4, and that's just an average mortgage insurance rate, depending on what amount you might put down. And then as you saw there, I'm just using a 7% interest rate. It's mid 2024, so just to use an example here of what that might look like. Now let's actually go onto the screen here and let's talk about, or take cake off the screen here and get onto the calculator. Now when we look at what a $2,600 payment would be, we can start just running some general numbers. So if we look at, say, a $300,000 home times 0.25%, that means our insurance is $750 per year divided by 12 months, 62.5, right? So maybe a lower amount if it's an older home, or maybe if your credit's a little bit lower, your insurance might be a little bit higher. But again, we're just trying to get a default number here. So if we use that $300,000 times 2%, now our taxes are $6,000 a year for this default scenario. Divided by 12 months, that's $500 per month. So now we're looking at $550 to $600 worth of taxes and insurance, right? We have not included mortgage insurance yet, so I'm just going to round out to say $600 of taxes, insurance from a homeowner's insurance from a mortgage insurance. Again, we're at a $0 of assessments. So that leaves $2,000 of a monthly payment. So $2,000, and you can insert the interest rate and say $2,000, and now we can use different loan amounts, right? So we talked about a $300,000 purchase. Well, if you put 10% down, that's a $270,000 loan. You can do basically on these fancy little calculators, right? They're like $20. Then you sit there and you can do the term of 30 years, interest rate is 7, and then it's going to give us our payment, right? And now we can kind of go through these different, and I'll throw up on the screen here some different payments based upon the principal and interest at a kind of generalized interest rate. But this hopefully will help you when you look at some of these mortgage calculators of how wrong some of them can be, but at least how to default and how to better understand what exactly can you afford. All right, now we're going to wrap up here, as mentioned, with monthly payments, and I'm actually going to compare them, and I'll show you on the screen here, to monthly rents, so you can kind of better understand what is going on. As you can see there, building equity, burning money, you're paying somebody else's mortgage, right? So $2,000 a month in rent, roughly $250,000 of home. And now again, that is all monthly payments. The example we used was around $2,600. So say $2,500 a monthly rent, you're getting around a $300,000 home. So very, very good example here, a close example, depending on obviously everywhere in the country that you might be, will have slightly different taxes, price points, things like that, right? But you can see going all the way down and say, hey, I'm paying $5,000 a month in rent. That's basically equating to a $600,000 house. Now, I'd love to hear your comments below. Do you think this is plausible? Are you able to do the math now? Have you got in over your skis? Was this helpful? I'd love to hear from you. Put any future topics down there as well. Thanks so much for tuning in. Stay safe, and we'll see each other again very, very soon.